Welcome back to FANG Friday. I'm Ross Healy, and I'm the chairman of Strategic Analysis Corporation. And today we're going to extend the FANGs to the FANGs plus one, because we want to include Disney, which has had the most impact on at least one of the FANGs this week. So let's take a look.
So, Disney this morning announced the details of its new streaming service, Disney Plus. Notable features are that it is going to be a lot cheaper than is the Netflix service, coming in at $7 a month as opposed to $9 to $13 for the regular Netflix service. While they're expecting quite a lineup of features, we have to say that the company also announced that while it expects 90 million households to subscribe, it does not anticipate that it's going to be profitable before 2024. So what happened to the stock this morning? Well, of course, it had a beautiful jump of some 10%. And where did that get to? It got right to the super growth price, maybe a couple of bucks beyond. But at the moment, it is sitting right there on the super growth, which has been the peak of the shares now for some period of time. What is notable on this chart is that the fair market value and the super growth price, which is 3.5 times adjusted book value, are at exactly the same level. And I would anticipate that there may be some issues with Disney getting any higher than that. However, allowing it to rise above that level, I would anticipate that we're going to see something like this, what happened with Amazon, where it came to a break point, rose above, and checked back there before moving on. Of course, what Disney really wants is to get something that looks like the valuation of Netflix. You can see Disney here is trading at, it was trading at 3.15 times book, now trading at 3.5, and a PE ratio of 17. Compare that with Netflix, which has got a forward PE ratio of 78 and a price to book of 25. So if Disney is successful, then the stock has a long way to go. However, the big operative question is if. In the meantime, Netflix set back on that same announcement, and as you can see, it had been banging its head against the HB5 price here, which is 25 times book value here, and has been unable to get through that for the last 3 months. And of course, now with potentially powerful competition to their service, probably is going to have even a more difficult time in doing so. I remain completely on the sidelines as far as Netflix is concerned. It is not a stock that I would touch unless or until it can actually break out, and I don't expect that it's going to be able to. And speaking about streaming services, of course, Amazon is launching its own, or has its own, streaming service. The Disney announcement didn't have much, in fact, it had no effect on Amazon whatsoever at all. And the stock remains in a hold condition as far as we're concerned. It broke out over its HB3, checked back, and has been moving steadily, I think, forwards, perhaps towards its HB4 price, which is about $2,100. Notice, however, that the stock is not what one would describe as cheap. Its forward PE ratio is almost 60 times, and its price to book ratio is almost 18. Turning to a stock that we have liked now for some while since the bottom, NVIDIA. Here was NVIDIA at the low. There it came right down to its bubble price. And the bubble price, which is 7.4 times book value, is a very, very significant valuation level from a mathematical point of view. Since that time, the stock actually ran up a breakpoint, checked right back again, but since that time, it has gone back up again and has broken out. Remember that I said, I think 2 or 3 or 4 weeks ago, that the stock was breaking out and probably would be heading for about $200. Well, currently that level is 203. At the present time, I don't particularly anticipate that the stock is going to be able to get beyond there. I've got to stop here for a moment and point out one very, very amusing factor about NVIDIA, and that is to say, look at the fair market value of the company. And that fair market value is, of course, based on the analyst's earnings forecast. As long as the stock was rising, the earnings forecasts kept on rising, and of course the fair market value, which is a derivative of those earnings forecasts, was rising. The stock falls out of bed and collapses down from, about 22, 23 times book value down to 7. And with a lag, look at what the analysts have done. They have decided to write down their earnings forecasts. Then the stock hits its bottom and starts to bounce. And with a lag, the analysts are following the company back up again. Talk about trend followers. You have to wonder exactly what those people are all thinking about and what their analysis is composed of. Turning to Alphabet, Google, Alphabet, the stock recovered to a structural valuation level. It's LSG, which is 4.5 times book value, and has since that time been struggling to go any higher. The stock needs to break out from here. Unfortunately, it does not particularly have the earnings and the fair market value to do so. In fact, the fair market value is some 24% lower than the current price. However, it's been there before, so we can't say it won't happen. However, I would say this, that I would not be a buyer of Alphabet unless or until it can break out over its LSG price. Apple has had a nice bounce off its mid-super growth price. That's 5.5 times book value. And as I have shown you in the past, that mid-super growth price was a 10-year peak for the valuation of the company before it broke out and had a kind of a walk on the wild side. In the market correction, the stock pulled right back down again to the top of that 10-year range and has had a bounce since then. I had actually not anticipated that the stock would be able to get above its fair market value. It got a couple of bucks below, or at least above that level, but has since checked back right to it. And finally, Facebook. Here, Facebook has been running hard up against its mid-super growth price. That's 5.5 times book value. Its fair market value was 20% lower than the current price, or $141. I do not think that Facebook is going to be able to break out from here. In fact, it is my general conviction in looking at all of the FANG stocks that they have actually achieved their highs for the cycle some while ago and are in the process now of the first decline and then a rebound. But I do not anticipate that the FANG stocks as a group are going to be able to attain new highs. Okay, so what have we found this week? Well, Disney is very promising, but it still has not given a buy signal. So don't get too excited about what's going to happen to the stock until you see that clear breakout that I talked about. For now, this has been Ross Healy, Chairman of Strategic Analysis Corporation, talking about the FANGs and leaving you with the thought that nothing, including investing, is difficult if you have the right tools.